So, is this the recession that never was? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. So if you have a question for me, please go to the website at www.prudentmoney.com. Send it in and I will get that taken care of for you. That's off the website, www.prudentmoney.com. So are we in a recession or not? This has almost become somewhat comical to me. Let's talk about the definition of a recession. A recession occurs when we have two consecutive negative quarters of growth. So let's take the January through March time period, that's a quarter, and then April through June, that's the second quarter. Two consecutive months of negative growth, meaning two consecutive months where the economy lost ground, not grew, occurred in the first two quarters of this year. But yet, it seemed as if nobody would accept it. I remember watching CNBC as the commentators were awaiting the dramatic results of the second quarter's growth, all assuming it's going to be positive. And shockingly was negative. They were all surprised. None of them thought it was going to be negative. So that would mean that since there was a negative quarter in the first quarter, a negative quarter in the second quarter, we are officially in a recession. And every one of those hosts of the CNBC morning show were, that first quarter was a little suspect. I don't think that is really, that we're in a recession. Besides and I can't think of the name of the governing body, but there's a governing body that goes back and looks at everything, readjusts numbers, which I've always thought was kind of crazy. And then they're the final authority on was it a recession or not a recession, which is all in the past, so it doesn't even matter. But but in the past, and I've been watching these things for over 30 years, never have I seen a time where commentators or the financial media, that's the accepted definition, but I don't really think it's a recession. Okay, so I guess we'll wait until you tell us what the acceptable definition changes are going to be. Maybe it needs to be 3 quarters. It's just so ridiculous to me. Anyway, that's beside the point. Enough of that. So we're waiting on the third quarter to come in. And one of the things that I strongly felt was that third quarter was going to come in positive because, number one, it would dismiss the first 2 quarters. We don't have to pay attention to those nagging negative results. And of course, it came in today and it was positive. But another reason why that I thought it would be positive, because we wouldn't want anyone to mistake the economy being in a recession with what's coming up in 2 weeks, or a week from Tuesday, midterm elections. Wouldn't want the word recession to be in there anywhere. So now with this positive number for growth in the economy, we don't have to worry about it. Jerome, and this is kind of a double-edged sword. Let me explain. With a third quarter positive number, meaning the third quarter grew, then there's two dynamics at play. Number one, you have Jerome Powell, who's the Fed chair, who's in charge of the committee that determines do interest rates go up or down or whatever to to affect inflation. He's getting major political pressure because of the fact that every time he raises interest rates, he literally puts the economy in jeopardy. And so he's getting a lot of political pressure because of his aggressive interest rate hiking to fight inflation. Now, you don't have to worry about that because we are positive for the quarter. And the good news is that once again we're heading into midterm elections. So the fact that he has no political pressure holding him back, he can continue to raise rates as he wants. The stock market looks at it from the standpoint of, once again, a double-edged sword. That, hey, on one hand, we're not in a, things are not as bad as we thought they were. We're not into a recession. Number two, and Jerome Powell can now feel free to raise rates as long as we've got a positive number that is or a positive result in growth of the economy for the last quarter. So it's kind of a complicated thing. But if you look at the growth numbers for the economy for this quarter, it's with an asterisk because there was a one-time positive contributing factor that really influenced this number. I don't know how much of it influenced, but it was a big influencer. We won't have that this next time. So we'll see what the next number brings. And the other thing too is that if you've noticed, really haven't mentioned that much about it because it's kind of been a non-story. But as the price of a barrel of oil has sunk down into the 80s, which is surprise, surprise, that all happened, 6 or so months before the midterm elections, gas has come down. Gas is not as big of a deal as it was. I expect that we'll start to see a price of a barrel of oil start going back up again. We'll see what happens right after the midterms. We'll talk about it. But I expect to see that happen. And because you don't want rising energy prices you don't want inflation to look like inflation. Said a different way, leading into the midterms. So that's what we got this morning, and I'll keep you posted on what transpires next quarter. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. I was talking a little bit yesterday about the webinar that we're doing tomorrow, and it's a repeat webinar. It's still going to be live of the webinar I did obviously yesterday. And it's the 5 questions that you need to be asking that could literally save your retirement. And I want to give you a little bit of an example of what we'll be talking about. Let's take Joe and Susan, 2 investors. They both retire at the same age. They both retire with the same amount of money. Their retirement plan is the same. They're going to take out the same amount of money each year. They're going to raise that withdrawal each year for inflation. They're going to invest in the same thing. Everything is the same except for the date that they start putting money back. Start taking money out. So Joe is cruising along, taking all this money out, just like Susan's taking all this money out. But at age 85, let me back up. He started with $1 million in investments. At age 85, he had $6.7 million left. Not bad. Pretty phenomenal. Susan, on the other hand, same amount of money invested, same growth rates, same withdrawal rates, and at age 85, her retirement is worth $57,000. So how in the world Could two investors that are investing the same way, taking out the same amount of money, starting at the same place, be so incredibly different at age 85? I mean, $57,000 versus $6.7 million is a drastically big difference between the two investors. Well, the answer to that, I think, will change your perception of investing and basically how it works. In fact, just knowing this would presume that you've kind of answered the other four questions as well. So I'm going to leave you in suspense, and we'll talk about the answer on Monday. But definitely we go over this and talk about this and why it's important to know. And all you have to do is go sign up for the webinar at prudentmoney.com. Just go to the website, say that you're going to attend, and then from there we can send you a link. If you were signed up for yesterday and you couldn't make it, just sign up again for tomorrow, and we'll send you a new link. And bring your questions, because we are definitely going to be going over questions at the end, and I'll stay as long as we need to answer as many questions as you've got. There are a lot of questions. People are really wondering about. This has been a horrible year for investments, and we're going to talk a little bit about this on the other side of the break. But it's just not been what anybody expected. And bonds are losing money, stocks are losing money, which is an odd thing. Only happens about 4% of the time. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. We're up against a break. Stick around. I'll be right back. Hi, this is Bob Brooks, host of the Prudent Money Radio Show. Well, 2022 has been a miserable year for investing. Will 2023 bring the same? You know, times like this have a way of making us feel stuck, not knowing what to do. Well, there are two keys to success in any kind of market. First, you have to be informed, but second, you have to receive that information in a way that anyone can understand it. This is my objective with the next Prudent Money webinar. There are 5 main questions that you should be asking right now. Number 1, what is a bear market, and what does a bear market really look like? This could tell us a whole lot about 2023. Number 2, why is it important to understand cycles when it comes to growing my retirement? Number 3, what do I need to know about inflation? You know, how high will these prices go? How do I protect myself from inflation? Number 4, why should I be careful with bonds? Number 5, what steps do I take now? You know, what are my options? Well, if you're unsure about the future, then this webinar is for you. Sign up now for the 5 questions that could save your retirement. There's 2 times we're going to present this webinar. The first one is on Wednesday, October 26th at noon, and the second one is Friday, October the 28th at noon as well. Today, sign up at prudentmoney.com.
Each day brings new challenges we didn't see coming, and everyone, including followers of Jesus, can feel overwhelmed at times. So, what are we supposed to do? Friday on The Verdict, we're going to tackle this question in a very practical and encouraging series called With Wings Like Eagles. Don't miss Friday on The Verdict.
Listen 10:30 a.m. on Bible School Radio 91.3.
Our journey through the Bible this week is action-packed. First, wicked King Ahab dies, and Elijah predicts the next king's death. Elijah calls down fire from heaven and parts the waters of the Jordan. Finally, Elijah ascends into heaven on a chariot of fire. And those are just the highlights. Join us for these great adventures in God's Word.
Listen daily, 6:30 p.m. on Bible School Radio 91.3.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. I do appreciate it. If you got a question for me, please go to the website at prudentmoney.com. Send a question in. I'll get you taken care of. That's all at the website, www.prudentmoney.com. Okay, so let's talk about a question that you may have experienced, what this listener is experiencing. It says, every month I express my concerns to my advisor, but he says not to worry. My 401k plan has lost over 20% and I can't afford to lose that kind of money. Is it time to find a new advisor? I'll bet that you're having some interesting conversations with your advisor. Now you gotta keep in mind, I don't know what the percentage is, but I would think that a high percentage of advisors today, the people who are practicing financial planning, financial advising, have never been through a bear market like this. And this is really, as far as bear markets go, it's really not even kicked into full gear yet. So you got to realize this is somewhat of their, maybe a lot of advisors' first time to be in a situation like this. And so it's a tough one. It's a tough one to know what to do. I would suggest it's where your advisor really earns his or her money. So let's talk about the questions that you should be asking. Let's talk about some of the assumptions that we would go through to answer this question overall. First of all, on your stock investments, history would suggest that you need to be able to be comfortable at any given time losing 20 to 25%. If you're on that from the standpoint of being a buy and hold investor, you've got to be able to lose 20 to 25%, assuming that it comes back. Now, if it goes 20 to 25%, that's kind of the line in the sand, and it continues to lose and continues to lose. That's a different conversation. But a general, so many times in history, a 20% loss over usually, maybe a 2 or 3 month time period is considered a correction and not a bear market. Now, if it gets over into bear market territory, that's why we give that 20 to 25%, because 20% is the marker for being a bear market. And what has happened this time around, which makes it a bear market, it went under the 20% line and stayed there for most of the year. So that makes it definitely a bear market. But you got to be comfortable with that. So that just kind of keep that in the back of your mind. But the one question that you need to ask is not, is it time to find a new advisor? Am I comfortable with my risk level? You've got to be comfortable with your risk level. You've got to know this is the worst case scenario and this is the best case scenario based on assumptions, and I'm comfortable with that, and during the best case scenario that can get me to my goals. So are you comfortable with your risk level? If not, what risk level will make you comfortable? Now this is where you got to be really, really careful with the answer that you come up with, because I've talked to many listeners who've called in and or written in and said, I'm not comfortable with this risk. Well, what are you comfortable with? No risk. I don't want to take any risk. Well, once you've been through a situation where you've lost a lot of money, the last thing you want to do is take any more risk. I get that. But the question is, taking less risk, will that get you to your goals? Now, we are in an interesting time period right now, and that is that you can get a fixed annuity, a guaranteed fixed annuity. There's no frills, no extras attached to it. It works just like CD. You can get a fixed annuity locked in at 5.5% guaranteed. So that kind of changes the risk conversation. And say that something like that appeals to you, say that you can move your 401k money, whatever, you can make that happen. If that will get you to your goals, that's pretty good situation to be considering. But for the most part, you would have to earn more than that to get to really where you need to go. So you have to have a risk level that matches that type of growth in your investments. So it's what am I comfortable with, and whatever I come to the decision that I'm comfortable with, will that help me get to my goals? I mean, that's the question. Now, so let's say that you have that conversation with your advisor. There's two different ways that they will approach that. One is they will talk to you, assuming they don't blow you off, and it's maybe not necessarily blowing you off, but it may be that there's a lot of advisors that go into hiding during times like this. Don't answer phone calls. Keep the phone calls very short, and try to get out of having those hard conversations. That's not what the good advisors are doing. That's just what a lot of advisors will do that. Saw a lot of that in 2007 or 2009 during the financial crisis. But they'll assuming that they take interest in your question, they'll respond verbally and they'll say, "Listen, Mr. or Mrs. Smith, you're long-term investors. The market goes through periods that you lose money. But there's one thing we can always count on, and it shows in history, the market always goes back up. And you always get the opportunity to recover what you've lost." I'm very confident about that, and I can show you charts that would prove that to be true. So I really wouldn't be concerned about where you are and the losses. And let's face it, you've already taken the losses. So if you sold today, you would be locked into the losses. Now that is, although there is some truth to what is being told there, it's not the entire story. And by the way, I do cover that in the webinar, the problem with long-term investing as a strategy and as a risk strategy as well. But they address it verbally, and that's one way. The second way is they ask a lot of questions about how you feel, about what risk looks like to you, and they respect the emotion that you're experiencing. I think that's the hardest thing for advisors to do, is to really sit back and say, you know what, this is really important. Let's talk through this and figure out what we need to do to get you at a level of peace. And at the same time, is that level of peace driven completely by emotion, which is not a good filter to make decisions upon, or is that level of emotion, is there some time where the client took a step back, looked at the big picture, and kind of compromised on what makes the most sense? A good advisor can have that conversation with you. Now, the problem that most advisors have today is that to make changes to reduce risk, they go to the old model of, well, let's increase some money in the bonds and decrease money in stocks. Well, we unfortunately are in about the 4% of the time in history where stocks and bonds are going down at the same time and losing money. Not only that, bonds are losing a lot of money. I mean, this is going to go down probably as the worst year in the history of the bond market. Worst year in the history of the bond market. So just changing that up in a traditional format is not necessarily going to correct the problem. So, in fact, I was talking to a friend of mine whose brother-in-law was 100% in stocks, and he told him, he's a financial advisor too, and he told him, he said, I really wouldn't have that much in stocks. This was back late 2021, before everything started coming down. Didn't listen to him, and today he's switching to 60-40 stocks and bonds. Well, that's going to reduce it a little bit, but not by much. In fact, that's probably going to end up hurting when the market does finally rebound, which I don't think is going to be for anytime soon. So, and you don't have advisors who manage money for the most part. Now, on the money management side, there are a lot of ways to reduce risk and to go about managing for this type of a market, because there's tools that an advisor who does manage money and is well versed in doing that can use to help you get to where you need to get and to manage risk along the way. So it's just a really tough time today for investing. And that's the first thing you got to realize, because not only are we in a bear market, I mean that's one issue, but the other issue is that stocks and bonds, which is all your 401k plans, are stocks and bonds. And this is one of the things we talk about on the webinar, is what is a substitute in the 401k plan for a bond? And that's a very important thing to know, so we cover that as well. So we'll see what the days in front of us bring, but I will say this: go sign up for the webinar for tomorrow, because it will be well worth your time. It's at noon, and it's about 45 minutes. I think it's a good investment of time. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you have a question for me, please go to the website and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.